Today we're going to cover planning for profit, and I am Tim Kenny. I'll be your guide. I'm a certified public accountant. I'm also a profit first professional, and so just a couple housekeeping things. Legal disclaimer. We've done our best to make this presentation accurate, and we're not providing any legal advice in this presentation. And if you're interested in using this content for any purposes, just let us know. A little bit about us. We like to think of ourselves as partners without equity for our clients. We cover clients at all stages. Business, worthwhile plans take time to realize, and appreciate the opportunity to work with our clients to experience those. One of the things that we work with all of our business clients is planning for profit. So today we're going to cover the two different approaches to planning for profit, the common needs of both of them. We're going to look at the traditional approach in some detail, and the profit first approach as well, and then make some time for questions and answers. So the two ways to plan for profit, it include the traditional approach, which is the approach that I learned about when I studied for my CPA exam. The other approach is the profit first approach, and that is based on the best-selling book by Mike Michalowicz, and we'll review a little bit about both of them. So let's dive into the traditional approach. This is how most businesses have historically thought of planning for profit, and we're going to look at some of the differences. So the formula is revenue minus expenses equals profit. And the reporting is generally on the profit and loss statement or income statement. And the tool that's used in planning for profit traditionally is a budget. And the credential, again, where I learned the traditional approach is certified public accounting. Under profit first, the formula is flipped. So as we'll see a little later on, it's revenue less expenses or less profit equals expense. So again, this is a big change for most. It's revenue less profit equals expense. So basically, you're moving out of your revenue, your profit allocation, and then whatever's left over, you're using to pay your expenses. The reporting is bank balance accounting, and the tool is a Google Sheet generally with allocation percentages built in to calculate how much money to move into the different accounts. Or recently, Relay Bank has come onto the scene, and that bank allows you to automatically move money after you've set up your percentages, which we'll get into more details later. The credential where I learned about this was becoming a profit first professional. But many business owners have deployed this methodology just by reading and studying Mike's book called Profit First. So these things are needed for both. Number one, software, accounting software, QuickBooks Online or QuickBooks Desktop are used by most privately held businesses. You need accurate accounting with reconciled bank accounts each month, well-organized chart of accounts so that you can clearly see the fixed and variable expenses separate. a little bit more about fixed and variable costs. Uh, your fixed costs would include rent, insurance, property taxes, uh, any salaries to employees, including officer salaries. Uh, variable costs would include any costs that are directly related to your revenue, including commissions, raw materials, credit card fees. Sometimes, there can be, anytime you've got pay based on the revenue, that would be included as a variable or direct cost. So graphically, it looks like this. So your fixed costs, whether you sell anything, are constant. Variable costs increase as you sell more. So I like this visual. So again, as your quantity produced increases, so does your variable cost. Just looking at how these two systems play out, we're going to look at an example of a scenario where we're trying to retire 10,000 of debt. So we have a profit goal to create enough profit to retire 10,000 of debt. So we're gonna look at how we would do that under both the traditional approach as well as the profit first approach. And we're going to assume a 40% effective tax rate. So that would include federal tax, that would include state tax, because that's one constant you're going to have to pay Uncle Sam in Illinois, no matter what approach you take. So also we're going to assume revenue of 750,000. This is going to be important with the profit first approach, which we'll get into in a minute. So under the traditional approach, we calculate how much profit is needed. And so that formula is the profit target, which in this case is 10,000, divided by 1 minus the effective tax rate. So the answer is 16,700. So we're going to need 16,700 of extra profit. Even though we're retiring 10,000 of debt, we're going to have taxes associated with creating that profit to retire the debt of 6,700. So we create a budget with at least 16,700 of net profit. The budget would have revenue and less the fixed and variable expense before coming up with the net profit. And we're going to take that budget and load it up into our accounting system. For most, it's QuickBooks Online. And then we're going to monitor this at least on a monthly basis with a budget versus actual report. So there's ways within QuickBooks Online to set up a memorized report so we can easily get that report. There's even ways to set up an email that is automatically sent to us with that report. So next we're going to look at what this looks like under Profit First. So under Profit First, remember I mentioned that understanding what our revenue is important because that drives the target allocation percentages. So we're going to set our targets based on our revenue. And if you read the book, and we're going to have webinars specifically for Profit First, where we get into more of the how-tos with this methodology. But with Profit First, we're identifying targets based on revenue. So 750,000 would fall into this target band. So the profit allocation percent is 15%, owner comp is 20%, tax 15%, and operating expenses is 50%. Next, we're going to set up bank accounts. So we're going to have at least these 5 accounts. And then we're going to move money each week based on that week's deposits and the percentages. So in our example, we're moving the calculated allocation. So again, we're moving 15% to profit, 20% to owner's comp, and 15% to tax, and then the balance is going to operating expenses. What is in operating expenses is what we're using to pay our expenses outside of those other ones. And we're saving profit out of every deposit. That's why it's profit first. So the first allocation is to profit. So we're always profiting. Now, many of you are saying, well, I'd love to have 15% of revenue be profit, and especially sitting in a separate savings account. As Mike likes to say, Rome wasn't built in a day. So what we do is we come up with a rollout plan. So it may take 6 business quarters to get up to an allocation percentage of 15%. But over time, you can get there, and maybe you start out with 2%. So that would be something that we would discuss in a rollout plan with a business owner. But in this case, when you think about it, if you are fully deploying profit first, what that means is you've got 15% sitting in a profit account, and on 750,000 of revenue, that is the equivalent of 112,500. Quarterly, you would take a distribution from that profit account and use a percentage of that to pay down the debt. So this is the mechanism for paying down the debt. We're not planning for that 16,700 necessarily. We're just taking a percent of how much is distributed each quarter, and we're using that percent to pay down our debt. And you can see that very quickly, if we're effectively deploying profit first, we can easily retire that debt. Now, just like in the other, we plan for taxes. With profit first, remember on the allocations, we're moving money into a separate tax account. So this 15%, as you can see, is across the board. So that 15% really translates to many times more than the effective tax rate of the business owner or owners. So you've essentially got money sitting in a separate tax savings account to make your quarterly estimates or cover the other taxes. So the other aspect when you're paying down the debt is Mike recommends paying down the debt as quickly as possible. So the best practice with debt repayment, if that's the profit goal, is to use 90% to retire the debt. The other aspect about profit first is it's a system where once you're fully deploying it, you really shouldn't need to have debt, because you're going to be always profiting first, and you're going to be managing your expenses from what's actually sitting in your operating expense account. So we covered a lot, and I just want to thank everyone for coming and just allow some time for questions on anything we've covered.
Hi, Tim.
Hi, Mike.
So as far as managing expenses, is your best practice to sit down with your controller monthly, look at them, and therefore, make sure that you are sort of meeting your expense goal, and then just adjust monthly, quarterly? Obviously, some of that might mean reduction in headcount, reduction, like what's your best practice there in terms of managing to the expense you want?
Yeah, so that's a great question. So if you're finding that there's not enough cash sitting in the operating expense account, then it's time to do a line by line analysis of your expenses. So there is a tool that we use. It's called the Monthly Nut, and that's a profit first tool. And basically, you're just going through all your expenses and coming up with what that total is. And then looking at the expenses in relation to whether they are important to revenue or whether there is another alternative that is, going to give you the same benefit of that vendor. However, there's a cheaper source. Does that make sense?
Yep. Yeah. So it's kind of just keeps your focus on your expenses, whereas like in our model that perhaps we sort of fall asleep at the wheel a little bit more. This just kind of makes you hyper focused on it.
Well, yeah, because you need to pay a vendor and there's no money in the account.
Yep. Yep.
So
Okay.
It's an automatic
Thank you.
trigger versus, well, normally, if we look back at the traditional approach, it's, if the money's in the account, it's going to get spent, right? There's always a vendor that needs to get paid.
True. Very true.
And so, it's
absolutely
that idea.
Okay. I like it.
Yeah. So it forces, like a little rigor into your process of managing expenses. And essentially, it can be painful, when you have to kind of actively work with vendors and say, look, hey, I can't pay you today, but I'm getting a deposit in. I'll have room to pay you in a couple weeks. It makes that process part of your operating procedures.
Got it. Thank you. Makes sense.
Yeah. One other thing, if you're new to Profit First, is looking at owner compensation. This is not intuitive. Owner compensation includes, in the case of an S corporation, it would include any payroll. It would also include regular distributions that are used for regular personal expenses. The profit distribution is separate. So the profit is a separate distribution at the end of the quarter. So the idea is, you need to be motivated to do the work. And the motivating factor, or the carrot, is really that profit distribution. That's something that most entrepreneurs don't experience because there's never excess funds. The vendors usually eat it all up. So this process, the fruit of it is having a regular quarterly profit distribution. So one other approach with Profit First is, if we needed to purchase a big piece of equipment, or if we wanted to hire or open up a separate office, and we figured out that office is going to be X dollars, conservatively to open, we could open up a separate account for, say, office B, and allocate funds into that account. And then once we hit our number, we'd know that we have enough funds to open that office. So it's a really nice system. What's great about it is, really the only reporting that you need is to look at the bank, because you'll have a separate account for each of those initiatives. So whether it's profit, owner comp, tax, operating expense, or that second office, you're gonna be able to log on to your bank account and see straight off what the funds are in that account, and get a real good feel for where your money's at. Any other questions? All right, well, I'm gonna wrap up then a little early. Again, we covered an awful lot. The main purpose was really to understand the different types of planning for profit. And I think the traditional one is the one that most business owners think of. However, it doesn't always serve them well, because it's difficult to manage. Even if you're using best practice tools like a budget, and you're regularly meeting with your controller and going over your budget versus actual, it's not as effective as deploying profit first, where you're actually moving money into separate accounts and ensuring that you're always profiting. So, well, thank you all for joining me, and we'll see you next month.